Welcome to Dominator TV, Episode 1. So happy to finally be here. This episode kicks off our series in our first segment outlining 10 steps to buying a home. First-time home buyers, this is your calling card. Sit down, take notes, memorize my voice in your head in a totally non-creepy way, and more importantly than anything, put my advice into action. After all, it's free, really hard to come by without hiring a professional. As always, keep in mind that my business functions in East Tennessee, and everyone's buying process can vary or have extra steps added or taken away depending on their own situations. Nevertheless, this deep dive into making home ownership readily available to you starts now. Here with Terry Buholtz, and I want to ask him, what's the first step to buying a house? Terry?
Pre-qualification would be great.
Damn, you got it right. Why is that important?
Well, you can't buy a house without the funds.
He's got a point. We're here with Paula Divers. Spontaneous real estate question. What's the first part of buying a house?
Finding a real estate agent.
Ooh, she's good. Correct answer, pre-qualification. You heard him, folks. The very first thing you, as a prospective homeowner, needs to do is get pre-qualified for a mortgage. In the event you happen to have enough cash to close on the property you're buying, or have assets you can free up quickly, you can definitely skim through the pre-qualification bit. Unless, of course, you're interested in taking out a mortgage so you don't spend all that cash. For the rest of us, we're going to need to borrow money or finance a house using a mortgage. A mortgage is a legal agreement by which a bank or other creditor lends money at the interest in exchange for taking title of the debtor's property with the condition that the conveyance of the title becomes void upon the payment of the debt. To keep it simple, a bank, mortgage company, or private lender is going to provide the cash for you to purchase your home in the amount of any funds you don't already have, up to 100% and sometimes more. The lender, as we call them in the day-to-day, will then place a lien on your property when the deed is filed under your name. At this point, you still have legal interest in the property and a right to any equity you build outside of your outstanding balance to the lender. This all means that the property is rightly yours, but if you fail to pay your mortgage to the lender or the mortgage holder, they have the right to take possession, kick you out, and sell it for as much as they can to satisfy the money you owe to them. Don't let the foreclosure process scare you too much. If you happen to follow the right plan, it will never happen to you. On top of that, most institutions are super understanding and work with you. The bottom line is that if you've loaned someone $100,000, you'd probably be a little strict about your payments too. So who in the world are you going to talk to about getting a mortgage? If you're working with a real estate professional, using their preferred lenders is usually a really good idea. That means the real estate agent has worked with this lender before and is happy with the service they provided to the clients. Any good agent is picky about who they refer. As a customer, however, you can pick whoever you'd like. Keep in mind that different lenders have different specialties and different loans they can work with. Sometimes their qualification requirements are also different. Your best bet is to do some review searching online and see what past customers have had to say about a particular lender. Make yourself a list of 2 or 3 that you really think might be good options and call each one of them and ask these important questions. Number 1, what kind of loan options may be available to me? The lender should be able to screen what sort of property or house you're looking for and give you a brief summary of what's available. Number 2, can you pre-screen me before pulling my credit to see which options suit me best or if I can even get a loan? This is an important question because you may end up talking to 2 or 3 lenders before this is over. While it's true that a lender doesn't know whether or not they can make a decision without looking at your credit, there are certain pre-qualifiers that they can ask first to make sure you are ready or are a good fit for them. Pre-screens may include veteran status, income brackets, what you think your credit score is, location of home, condition of home, amount of money available for down payment, if any, outstanding trade lines, and quite a few other things they could end up asking. Number 3, What specific programs and services do you offer that I can't find anywhere else? Many lenders have in-house specialty programs that others do not. For example, the lender could offer 100% conventional financing in your area with a lower interest rate than a government-insured loan given by another lender. You'll never know about the perks of each if you don't shop around. 4. What interest rates and other financial factors do I need to consider with you? This is the part where you ask about the interest rates you may incur, whether or not different loans require private mortgage insurance, and how much the lenders will charge to originate the loan and process it. Number 5, and probably the most important, will you stay on top of communication to help me make this move as easy as possible and answer my questions as they come up? Bottom line, this journey will not work for you if you can't communicate efficiently and healthily with your professional. Many a deal have been wrecked by poor communication skills. Choose carefully, please. After you ask these questions, and hopefully more that you've created for yourself, you should be ready to make the following decisions. 1. Am I ready to get a mortgage and take on the obligation to pay it back? I hope that you've gotten ready at this point, but if you're not, maybe work on improving your finances and getting to a place where you think you might be better suited. Or 2, which lender works best for my own financial situation? Once you've chosen the lender you'd like to do business with, they will have you put in an application and submit a lot of documentation in order to pre-qualify you. Here are a few things they'll probably ask for: pay stubs, W-2s, 1099s, bank statements, copy of your government-issued IDs, tax returns, divorce decrees, bankruptcy papers, etc., if you have them. This part is important. Please remember that your inability to provide a certain document or your answer to a question that isn't the answer they were looking for is not necessarily a disqualifying factor. What the lender is trying to do is determine which step is the best step for you to take. There's a program out there for most people who manage their bills responsibly. The lender's trying to help you find it. The lender will then pull your credit and look into all of your financial details. This could take a couple of hours or a couple of days depending on whether or not the lender has everything they need or maybe even their current workload. It is important to be patient and let them go through everything, as details are super important in the mortgage world. At last, you will finally receive an answer. Basically, a yes, in which case you'll be moving on to step 2 of the home buying process, or a not yet. But here's what you need to do. In this case, the lender will outline the factors that led to your ineligibility and get you on a path to taking care of them so that you may qualify in the future. If this is the case for you, do not be discouraged. I have tons of links to credit repair tips and tricks and a whirlwind of lenders and programs that may have an option for you. We'll get you there. Let's talk about that yes. Having a pre-approval or pre-qualification means that you meet the basic criteria for a candidate for that particular program. It is not, however, a guarantee of any sort. The final approval is given during the underwriting process after the loan company has had time to process all of your files and pull a final credit check. This means that it's super important not to make any large financial changes from the time you get approved to the time you close on your house. For example, Jill gets pre-approved for a loan through Door Hinge Mortgage. She puts in an offer on a house and it gets accepted. Yay! Jill needs a new living room suite to match her exposed beams, so she scrambles on down to the retail store to finance $5,000 worth of furniture. They run Jill's credit and now she's approved for the furniture and she's obligated to pay it on a monthly basis. They take note of her move-in date so they can put everything in her house when she's ready, and off she goes. 3 weeks later, Jill's lender orders the final underwriting and approval for Jill's loan just a few days before closing. Now at this point, keep in mind that they've gone through inspection periods, resolution periods, appraisals. They've jumped every hurdle there is. They're ready to go. Jill is so excited about getting the keys on Friday. The underwriter then does a final credit pull and notices that she has taken out another loan. And this loan dropped her credit score and changed her debt to income ratio. Most likely, Jill's not going to get to close. Now everybody's angry and heartbroken, and the only winners here are the furniture store. Jill may be able to reapply later and fix all this, but it will certainly be a pain in the rear, especially if that seller is not willing to wait on her. In most cases, the buyer has to walk. Don't be Jill. Now that you've been pre-approved, you need to pay attention to a few factors. What type or types of loan did you qualify for? How much value did you qualify for? What specific parameters do you need to know for this loan type? For example, a USDA loan has certain zones throughout the United States where properties are labeled eligible or ineligible. What will your monthly payment estimate be at different values? For this one, let's look at a pre-approval for $150,000. I would advise the buyer to get monthly payment estimate for 3 different value ranges. One for $150,000, one for $135,000, and one for $120,000. Just so you're comfortable with exactly how much you're going to be spending each month. The lender will be happy to run these estimates for you, if they're good anyway. Keep in mind that the property taxes and insurance are going to change your estimate, so treat it as just that, an estimate. A good rule of thumb is to always get a property's specific estimate prior to submitting the offer. That is a pro trick. Now that we've covered the basics of getting pre-qualified, let's wrap it all up with some different loan types that you will hear through this process. Don't lose me here. Conventional mortgage. A conventional mortgage is an in-house loan offered by any specific institution. They often require some sort of down payment, perhaps 3% to 20% depending on your situation, and they rarely offer any form of closing cost assistance. Conventional loans often take a slightly higher credit score and more money down, which has made them a much less popular with the first-time homebuyer community. Buyers who've saved up a bit of money can take on the down payment, and closing costs often get rewarded by having a lower interest rate than others and an easier closing process. Conventional mortgages are popular and most feasible with those buyers whose credit is in pretty good shape. Some lenders starting with a minimum credit score requirement of 640 and going up from there. This path is also popular with those customers who are using the property as an investment, a flip, or a second home. In some rare cases, a mortgage company will provide a conventional loan with no down payment required and lower credit score requirements than others. This type of mortgage offers banks the most flexibility to bring in more customers. FHA mortgage. An FHA mortgage is a mortgage offered through any individual lender that is insured by the Federal Housing Administration. This program makes it easier for lenders to give money to customers who couldn't meet the requirements for an in-house loan or perhaps didn't have as much of a down payment to work with. Because the money is being insured by the Fed, banks can be more flexible with credit score requirements, some of which go as low as 580. In fact, I've actually heard of an FHA loan being processed with a 517 score, and he had a pretty hefty down payment. That's sort of a know what your lender can do type situation. All FHA mortgages require a minimum and usually just a set 3.5% down payment and cannot be borrowed from another source. When I say 3.5%, I mean 3.5% of the purchase price of the house. Therefore, if the house is $100,000, 3.5% is $3,500. In certain cases, the down payment can be a gift, but can only be received from certain people in relation to the borrower. All homes purchased with FHA financing must meet certain criteria pertaining to safety and livability on top of what the bank requires for their loans. This ensures the ability of the lender to resell the property in the event of a foreclosure. So I've seen FHA appraisals require chipping paint to be sanded down and repainted, HVAC to be fixed, heating sources to be made permanent, all sorts of different things. They basically want to make sure the house is livable. Let's talk about a USDA mortgage. A USDA mortgage is one offered through any individual lender and is insured by the United States Department of Agriculture as an incentive program to provide more affordable housing opportunities in rural areas. These loans are location specific and tend to exclude urban and suburban areas. A USDA loan offers 100% financing, meaning that no down payment is required, although closing costs will be the borrower's responsibility to come up with. Just like the FHA insured loans, USDA has a similar housing requirement that must be met and has one big difference than the others. USDA will not allow any manufactured homes to be financed with this program, regardless of foundation work or whether or not they're tethered to the ground or have a quote-unquote permanent foundation. They will not allow a manufactured home. For a link to the national database of eligible USDA locations, please visit, and I'm going to put it right here so everybody can see, but for those who might be listening, that's eligibility.scegov.usda.gov. THDA mortgage. This one's specific to Tennessee. In Tennessee, the Tennessee Housing Development Agency offers a grant on top of an FHA insured mortgage that gives an additional 5% of the purchase price to the borrower to be used towards a down payment and or closing costs and prepaids. Because an FHA's down payment will be 3.5%, that leaves an extra 1.5% of the purchase price that the borrowers may use to help pay for closing. Other states may have programs similar to this one, but as far as I know, it is just Tennessee specific. Before we get into split atoms with all these different types of mortgage types, I must tell you that there are way more out there than I can even list. In future episodes, we will cover options for people looking for construction loans, transfer loans, and private lenders. The options I've given you today are some of the most common that a typical home buyer will encounter during their pre-qualification process. Remember to reach out to those individual lenders and find the best program for you. I will go ahead and make a comment right here that it is important to note that a down payment is separate from closing costs. So a down payment is an initial payment that you put down on a loan that goes toward the principal, and it's specifically for the loan. So if it's 3.5% down payment, that's 3.5% that you put down. Closing costs are a little bit different. Closing costs aren't actually seen as part of the loan. They are the costs that it costs to close a loan. These could include fees that your lender charges to write the loan, any credit application fees. In some cases, they can be inspection fees. They can often just be any title fees, recording fees, things that happen at closing, the closing attorney's fees, and they come up to a pretty good chunk. So any extra money that you can get to help with those certainly does make a difference at the closing table, but it is separate from a down payment, and that is important to note. We will go into closing costs, prepaids, and title expenses in another episode in detail, but I wanted to throw that out there. Now that you're equipped with a pre-approval, it's safe to say that you can go look at houses and have a good idea of what you can or want to afford. This is Dominator TV, hosted by me, Dave the Dominator. Thanks for watching. Remember to follow me on social media, and I literally mean any of it. Find me on Facebook at Dave the Dominator, YouTube at Dominator TV, Instagram at Dave the Dominator, just one word, and Twitter at Dave Dominator 18, because apparently that one has been taken before. These videos will be distributed as podcasts and found wherever you get your podcasts. I can be emailed directly with any comments, questions, or feedback at dave@davethedominator.com. For local real estate advice, email me, call me, or text 423-290-6827. Reach out to me personally with any situation-specific or location-specific questions that you'll have, and I'll happily work with you to get those answers. All information given in this episode is to be considered a general summary for the pre-qualification process and is not to be taken in lieu of advice given by a licensed mortgage originator. It's simply here to help you make the best decisions possible. Dominator TV is created, hosted, and edited by David the Dominator Sanders, Realtor and Team Leader, Coldwell Banker Kennard Realty in Cleveland, Tennessee. Mobile number 423-290-6827. Office 423-476-5532. Each Coldwell Banker office is independently owned and operated.